Let's get some insights on the news shaping the markets. For that, we welcome in Ben Emons, Senior Portfolio Manager, Head of Fixed Income Macro Strategy at New Edge Wealth. Thank you for being here.
Yeah, happy Friday.
So look, we made it through another week. I feel like we've gotten in so much news, and the PPI and the CPI and lots of earnings still. Some of your thoughts here as we're hovering around the records.
Yeah, I think it's really a market about embracing this inflation again going lower. And I don't agree with that itself, because I think inflation numbers showed still a lot of stickiness and there's risk for it to flare up if the economy stays strong. But the market seems to be grabbing on any piece of statistical news in there that gives them reason to take on risk. So I think the extraordinary part of this week obviously was how we started out with meme stocks really on fire and selling off hard, whereas the broader market took off while after the CPI data. So I think it indicates people willing to take more risk as there's liquidity, and then come to that sense in saying, good economy, let's keep rotating from tech to energy and utilities and materials and you name it. And I think this is the sentiment we'll stay in for the time being.
So you're concerned about the stickiness of inflation. As a matter of fact, some of the times we've spoken in the last few rounds, you were still thinking, and we know the Fed thinks that, policy is amply restrictive at this point, but never said we will never hike again. I mean, there was none of that. I mean, that sort of was still something that was looming over the last few months. Is that still looming, a hike?
It always is. I don't think that's changed. In fact, I think it was Bostic or Bark and one of the two continue to mention it, saying if the inflation numbers do not go our direction, we have to reconsider. And that, I think, is important for markets to understand. The Fed has a contingency on inflation. And that's, on the one hand, comforting, I think, to markets in the sense that the Fed is not going to be behind the curve. On the other hand, it's not in the price of the markets itself to see a rate hike. Other than that, it's really about a market that says, like Fed, you stay on hold. If you look at the bond market, for example, it's really pricing in the Fed to be on hold potentially for the next 5 years. You look at the yield curve as an example. I do think markets are saying this is not going to be a whole lot of change in monetary policy in and by itself. They're not a very shallow easing cycle, and that's a soft landing. So I think it's positive.
So you talked about food and beverage sector. I'm looking for some areas that you talked about copper and gold. I mean, you have some different sector thoughts here. Are any of them investable right now?
I think all of them are. I guess what's happening with the metals, particularly with copper and gold, I mean, on the one hand, copper reacts to what's happening in the supply chain for semiconductors, and then that's really linked to that. Mm-hmm. And maybe to an extent what's going on with China. Gold is really a puzzling piece here, because it's on the one hand an asset where the uncertainty shows up. As in, people buy gold to be worried about the geopolitics or the inflation picture, and yet we don't feel much worried given where the record highs are in stocks. On the other hand, inflation can sometimes be very profitable. If you look at those food sectors, for example, I mean, those stocks have beat the S&P by roughly the headline CPI for the year. I think that's interesting because it does show you that you can pass on inflation and make profits, and I do think that's important for this economy.
So do you like some of the food stocks? You talk about some of them. I mean, I guess some of these would be staples. And I see your food inflation chart as well. So copper and gold, you think, have some room to the upside, it sounds like.
Yes.
And some of the food stocks or staples, do you think there's some room there?
As a firm, we're not really positioned that way, but I think it's an interesting proposition here, because the way you see food inflation currently...
Something to think about.
Yeah, something to think about. It looks a lot like 70s, right? So it has more scope potential for staying really high, but it's profitable for those companies.
And then how about what else as a firm? What are you positioned in, or where is the money allocated?
So we've always been in this combination of energy, financials versus tech. It's been a very favorable combination so far. I dub it for myself as the acronym BEST. You have banks, emerging markets, which sort of a fixed income allocation. You have semis and tech. It seems to be really the combination here this year that's sort of playing out. So let your winners ride, we say, and stay with those.
So all three of them?
All three of them. They don't seem to be really moving in a different direction at this point.
I don't feel that when we look over the last 10 years, I mean, I always said, if you have energy, tech, and financials with up arrows, that's a win. It doesn't matter what else is down.
Yeah.
but you need all three of them. It's hard if just energy's up and financials and tech. So you just sort of stay in all three and hope for the best, I guess. I mean, what will drive this? I mean, energy, for example, was $79 a barrel for oil. Do you see that heading higher?
Probably. I mean, if the economy stays on track.
Right.
Now, everybody's also taking note of the utilities as a sidetrack to that. And that's been driven, I think, really because of the demand for power. And that's related to energy, right? So there's a subsector people are playing that play because it was a very undervalued sector. We, by the way, have been positioned in the utilities since the fall of last year because we saw it as an undervalued play to energy. On the other hand, I think if you look at energy globally, so far it seems to be the story from China not really driving the energy picture. It's more like the supply picture of energy is continues to be one of tightening supply, which keeps the price here elevated until perhaps some more demand will drive it up to $100 a barrel. Maybe that will happen this summer. We think it's an interesting play because the energy companies itself are relatively undervalued to the tech companies.
We're going to have a panel later on the meme stocks, but you did send in a great chart which includes BlackBerry, AMC, Plug, Hood, GameStop, of course. Some thoughts or anything that I should bring up in the discussion?
So if you think of memes, on one hand you think of this word malarkey, right? There's a lot of discussion there that I'm not sure what it really means.
Yeah.
But what is an interesting theme here is, and that is, I think, important for that sector, is that what GameStop is doing today, and again, I'm not an analyst on GameStop, but just observing, they are raising equity because of the spike in their stock price. AMC did the same thing the other day, and as the media company from Trump did that too, from the SPAC merger. So it is a bit about those stocks are very volatile, they rise because of all the malarkey and the social media aspect, but then these companies take strategic positions on that, saying we can raise equity and raise capital and take advantage of this wide open capital market, stock price can go up. So that's a bit dilutive for the equity holders. I think this is part of the volatility picture that you're seeing in these stocks. I would caution, though, to any investor listening to this, like, these are not your normal stocks to trade in, right? So you have to be careful.
Ben Emons, New Edge Wealth, thank you so much for being with us today. Appreciate it.